Brexit, bit of a potential joker in the pack. Alvin Baker, Informa Global Markets. According to the IMF, only two countries warranted raising interest rates in 2016, the UK and the US. Alvin, what can we expect from one of the main announcements this week, the interest rate decision made by the Bank of England?
Even though the FOMC have made their move, markets don't really expect the UK to follow suit in the next few meetings. Generally, the markets are very sanguine about Bank of England tightening prospects, especially in H1. And we attach maybe a 50% chance of a hike this year. Projections for tightening have been pushed out to Q3 or Q4 from Q2. And it's the overnight index swaps that are pricing in no move at all this year. Indeed, they've recently been pushing out 75 basis points to be priced in by H2 next year, and some even thinking that that might be pushed out if there's an adverse Brexit vote. Some of the rationale is attached to wages because what's happened in the last few months, that they've dropped off quite dramatically. The last 3 months average is 2.4%. Last month's print was only 2%, which was the lowest since Feb. So there's been a marked deceleration in average earnings growth, and some people think that this cycle has topped out and we may be sort of seeing a sharp further deceleration in this dynamic. Given that we're not going to get much inflation from earnings now, and manufacturing in the doldrums, the floods in November, December will be a drag on Q4 GDP. We already know that, so H1 may see a rebound, but that's going to come in dribs and drabs. So growth is going to be very subdued compared to what it was this time last year. All these reasons, coupled with government spending, and then there's, as I mentioned briefly, Brexit is a bit of a potential joker in the pack, and that's going to also stay the Bank of England's hand. So as far as the market's concerned, even if the Fed were to hike again in March or April, we think the Bank of England will be able to safely look at its own house and not move at all until late in the year, if at all.
Mario Draghi has hinted that adjustments could be made to the QE programme if necessary. Following the Eurozone inflation missing expectations, should the markets expect any indications of significant changes to the future QE programme following the ECB meeting minute release?
The ECB has already said that it won't be reviewing QE until March, so this January meeting comes far too soon. Having said that, very much similar to the Bank of England, very nervously looking at what's going on in China, the direction of where the global economy is going, and as mentioned, the flash Eurozone inflation figure was so far below expectations that the star forecasts, which come out the day after the ECB meeting on January the 21st, should be revised sharply lower. With that, there's maybe an implicit QE pledge via those expectations. But in the minutes this week, we don't expect to see too much in the way of new clues. There may be a little bit more about the politics behind the split decision to go with just 10 basis points off the deposit rate as versus more expected by the market, and also the QE extension not being as bullish as some people were also thinking.
Looking at the release of US retail sales for December, online retail sales are expected to be positive, with some analysts saying consumers were spending money saved on low gas prices. How much of an impact are you expecting car sales to have on this data, considering weak car sales weighing on data in Q3 of 2015?
Consensus looks for overall soft, disappointing figures for December at 0.1% month-on-month, with the ex-autos component up by just a modest 0.2%, but there's a very wide range of forecasts, some flat, some even negative. The key number for GDP tracking is in the core spending, in the core control sales number, which excludes food, gasoline, autos and building materials. That is seen up a decent 0.3%. Internet sales will come in the non-store retailers category in the Commerce Department, and these have been quite strong since October, and they're likely to stay that way compared to bricks and mortar and retailers and department stores. The other component that may fare well is the recreational eating out, which was up 0.7% in November, and this is where we think that the additional savings from lower gas prices has been spent by the consumer in this particular sector.
Well, Alvin, thank you for your insights. That's all from me, but this week is filled with exclusive interviews covering significant movements on the markets. Goodbye for now.